UK. We've got Fred and myself. And tonight we're going to be talking about our in-house programs that we use within the MetaTrader 4 environment to develop our diversified trend-following portfolios. This is our first workshop we're having in this series. We'll see how far we get today, but the intent is for our members to basically go through the step-by-step instructions of how to use the in-house algorithms to develop these portfolios. And Louis, I know you've now gone through this entire process yourself, and I saw your post last night where you'd completed the process and you're already you're almost ready to put it onto the demo environment. How did it all go?
Yeah, fantastic. I mean, step by step on the website, everything's thoroughly explained. So yeah, I didn't really have any major problems. Well, I did have one major problem, and I had to start again, but that could have been avoided. It was just with the swaps, because I was using FXCM, which I set up in the Middle East. And it just basically didn't show the swaps on the MT4 environment. I've
had a brainwave as to what was occurring there.
Right.
I think because it was set up in the Middle East, I think you were using a what they call an Islamic account.
Right.
And in Saudi Arabia and a lot of the Arabic states, they don't like the concept of interest-bearing loans. And so the retail brokers offer what they call Islamic accounts, which therefore do not charge any swap on those particular accounts. But there might be other ways to claw back some revenues from their clients through higher spreads or commissions or whatever. But so we've bumped into these Islamic accounts before. In fact, if you're trading, portfolios using the carry trade principle, there might be some opportunities with these Islamic accounts, but I think that's probably what you were trading.
Right, okay, got you. Well, I mean, I solved the problem anyway. I just migrated across to Pepperstone, and I just started the process again. So it took a while, but yeah, I've learnt my lesson. I'm now at stage 5. So yeah, I'm just in the process of downloading the VPS. I've just used the same one you guys use, and yeah, just getting everything set up really. Just before this phone call, I was just transferring all the EAs across to the charts. So yeah, just getting sort of set up and yeah.
Pretty exciting, mate. How long, if apart from that problem with the brokerage, how long would you say the process takes to get your portfolio up and running?
Well, I'm quite lucky, and I think we discussed this last time, Rich, that I've got a little bit of time at work, and I'm sat in front of a computer, so I can just set MT4 away in the morning and let it just churn away. But if I wasn't at a computer, it probably would have took a lot longer. But I think I signed up to the forum just before Christmas, and I've really sort of knuckled down and been on it constantly really since then. But obviously I had the problem with the swap, so I'd say a couple of months. But I mean, like you say, Rich, I think all the time you need to invest it up front, so it does take a while to get everything up and running. But once it is up and running, it's kind of, apart from the rebalancing, it can just run itself.
Yes.
So really, it's a small price to pay. I think it's just getting it set up and running. You're dotting the I's, crossing the T's, making sure it's all working, and then you're set really.
Yes. Look, we've tried to systemize it as much as possible, but really there are no shortcuts. You're basically bound by the speed of your processing capacity of your PC.
Yeah.
So that really is the ultimate thing that determines how long this whole process takes, is the grunt of your PC sort of thing. But it does take a long time.
What I did, Rich, was just obviously I just downloaded loads of different Pepperstone accounts and had them running sort of concurrently. So I had like 5 accounts but demo open, and I just ran different pairs on different accounts to speed up the process.
Okay.
So it was a bit quicker. I mean, at one point I had about 6 or 7 accounts and all demo testing different pairs at the same time, but it just slowed down my computer quite considerably.
Yes.
And then I started working off different computers as well. I had one running on my Mac at home. I had one at work. So that sort of did speed up the process.
Fred, is it one core per brokerage account?
Yeah, the MT4 is not particularly great at multitasking, and it's not using the resources of the computer, so it is only using the one core. But I don't know, but I suspect that multiple accounts will use different cores in the background. So in theory, it should. I mean, the reality is it should go faster, and it obviously has for Louis.
Yeah, Louis, how many did you get up running sort of fairly fast? How many did you get?
It did slow it down. What was of benefit is I only needed to click sort of once in the morning, because if I was running on sort of one MT4 account, I'd have to, if it was faster, I'd have to continually get back to my computer to start it again. And I was always forgetting because I was in meetings and whatnot.
Yes.
So I just had loads of them running. I just click it in the morning, so it didn't matter if it was a bit slow. I could just I could just press it in the morning and just let it crack on during the day.
Yeah.
So yeah, it just made it a little bit easier that way. But yeah, I mean, it's certainly it's a time-consuming process, but it just has to be done at the end of the day. It's quality in, quality out. You just
what I'm going to do, Louis, is I'm just going to put up your post on the. Can you guys see this?
Yep.
So I'm just going to. So this is Louis's result he's got of his portfolio. So you can see that he's trading a wide universe of CFDs and Forex instruments here and indices. That's a good universe. Nice wide distribution across asset classes. We can see the recency is definitely being showcased in the equity curve here, with the very strong uplift in the last 5 years, which is great. We can see that the robustness test has been passed. So whilst we can't use this as a method to project future returns, what we can do is make an assessment that, based on the past performance, our future trajectory should lie somewhere between the trajectory of the recency phase and the trajectory of the robustness phase. So it should positively project out into the future.
Rich,
yep.
You're using terminology that may not be, people may not be aware of if they're looking at this for the first time. So you probably need to go back a few steps and talk about what is recency, what is robustness, and maybe that brings you back to starting at stage one.
Yeah, yep. So this in-house process that we've developed within MetaTrader uses 5 core algorithms in the workflow process itself to develop these diversified portfolios. And as you can see here, Louis gone through the exercise, and this is the end result of the process where the portfolio is compiled. And Louis has run the portfolio under a backtest environment here and consolidated the results within Quant Analyzer, which is this software that makes a consolidation exercise a lot fairly an easy exercise. And so our particular process that we use within the MetaTrader environment focuses on 2 key aspects. One is that we recognize that markets are never stationary in nature, and they do adapt over time. So what that does in the trend following world means that the trends of the past aren't necessarily the same as the trends of the future. So we recognize that there is a degree of change in the trends themselves. And so in our workflow process, we ensure that it's an adaptable process, in that it's not a process where you might develop a portfolio and expect that portfolio to perform the same way for the next 20 to 30 years. What we do is a process where every year, when we undertake this process, we're continually adapting and enhancing our solutions to respond to more recent trending environments and ensure that the trends that we're capturing incorporate this degree of market adaptivity in it. Anything you guys would like to say in relation to that?
Just to confirm, Rich, I did just credit to you. I used your portfolio compiler first, and that was brilliant because I took out the negative skew. I looked at the way you mapped them to the market, and
Yes.
I treated it from that and then transferred it into a quant analyzer. So that was good to use first.
I think you've got a few extra bells and whistles in that process, Louis,
Yeah.
that others might not necessarily get, but I think they are very handy little components that map to market, and the the review of the different return streams and elimination of some that show this weakness in them.
Yeah.
So yeah.
Definitely. Just another question, Richard. On the I think the current version on the forum is it version 3? But the
Yes.
previous version was version 2, and it had a little bit. I think it had more charts on with the compounding and whatnot.
It did.
When you put it into quant analyzer, is the compounding effect in there as well? I suppose it is on the individual return streams, but
yes, not at the consolidated level. No,
not at the consolidated level. Right. Okay.
That's correct. So, but for instance, when you look at AUD USD, the individual return stream, which what I'm going to do is I'll show you another. These are the actual individual return streams for the portfolio. And if you look at an example here, like this orange one here, which is a very strong performer of the series, that looks, is that CAD JPY, Louis?
I think so, yes, or maybe soybeans.
Okay.
I think it's a commodity.
So these return streams would have been calculated using a 1% trade risk, and so each of these individual return streams compounds based on the 1% of trade equity. So as your equity builds for this individual return stream, your 1% therefore allocates a greater position size each time to it.
Yeah.
So that's a progressive build in a compounding way, but it won't compound it across the portfolio.
Right. Okay. So
that's a little extra bang up your sleeve.
Right.
So in the most conservative view, what we're doing is we've actually this result here is not compounded across the portfolio.
Yeah, I was thinking because your spreadsheet showed the return over the whole time series is much greater when you add the compounding effect in.
It is. And look, the reason I've removed them from the version 3 of the compiler is that you can get carried away with focusing on that compounded return stream. The emphasis needs to be placed on the risk weakness as opposed to the delights achieved by compounding, which is a natural result of all of this. But I think if we focus conservatively on the risk weakness as opposed to the performance returns, it's a much better way to view this entire process.
Yeah, got you.
So we talked about in our in-house process, we focus on the adaptable nature of markets, recognising that they're never stationary, they're always progressively evolving, and the trends, for instance, of the 1980s are different to the trends of today. What you notice, particularly since post GFC, with all of the central bank intervention, in that trends, the impact that or trending environments have considerably differed from what they have in the past, and the nature of the trends themselves aren't as clean cut as they were originally, probably attributed to the increased participation of algorithms, of central bank policy, of these different participants. And so the nature of trend has changed. We therefore have an adaptive process in this method, which ensures that we keep on ensuring that the trend following suite of algorithms that are ultimately developed through this process adapt also. The other major component of it, and so that's what we refer to as we refer to the adapting nature of the trending markets as the recency phase of the portfolio. And to explain that in terms of Louis' equity curve here, the last 5-year window is a period that we focus on the trending markets within that 5-year window, and we ensure that our algorithms are fine-tuned to the nature of those trending markets. Over the very long term, we refer to a concept called robustness, which is basically our method to ensure that our portfolios, at least in relation to what history has demonstrated, do not display signs of risk weakness. It means that they've been able to survive in a variety of different environments. In this case with Louis, for the last 20 years, we can't see any explicit signs of extreme risk weakness here with the nature of the equity curve. But we do notice that it's robust over the entire time frame, but importantly over the last 5 years we've got this significant improved performance because the algorithms have been honed to the trending nature of the last 5 years.
Just on the point of robustness, Rich, what I haven't done, and it might be worth doing, is, I think Izzy mentioned it, and I think obviously you pointed out as well, how you can sort of test the strategies for one particular market on other markets. I know the multi-market stage takes that into account, but it's something potentially you can do just to test for the robustness, I suppose.
Yeah, well, we do embed that within this. So that multi-market phase of this in-house process actually does that.
Right.
So when we get to that, we'll explain it probably better. But for example, a solution that we've developed that has been data mined within, for instance, Euro USD over the last 30 years. What we do once we've obtained that solution, we then apply it to the entire remaining balance of that universe within the Forex world, so all of our Forex instruments, and we ensure that up to a level, whatever we specify, in this case it might be 50%, 60%, 70% of those other markets also have positive expectation with that particular algorithm.
Yes, that's right. Sorry, yeah, that's stage
1A.
Yes, sorry, yeah, got you.
And so there's a couple of reasons we do that. One is we do that to increase the sample size effectively, because with these trend following algorithms, sometimes we can be on a trend for 2 to 3 years. The result is that if you backtest these solutions over, say, a 30-year time interval, you might only have 10 or 15 trades per solution, because some of them are holding for many, many years. So you can't actually get a high sample size on a per market basis. So by then testing that same algorithm across maybe 15 to 20 other markets and achieving positive expectation with the majority of them, we've effectively then significantly lifted our sample size.
Yep.
And also, one of the, in our robustness step, which is the first step we take of this entire exercise, we remove the impacts of trading costs so that we're purely looking at the nature of trending market, whether it's in Euro USD, whether it's in another Forex market. We're not looking at the cost structure and its impacts on the trending outcome. We're looking at the nature of the trending condition within those markets themselves in our robustness phase. Later, we in the recency step, we do then introduce the trading cost back into our models to then say, well, it has worked over trending markets in the past and it's demonstrated robustness. Now let's apply real live trading costs, real live trading environment to it, and see if the edge is sufficient to achieve positive expectancy when we introduce the real costs of trading into this exercise.
Rich,
Yes.
I think we need to start at stage one, or the whole idea of this workshop was to step people through it. I think we need to go back now and start that process.
Okay, so what I'll just quickly do is I'm just going to show our members where they can obtain this information. So if they go to the members forum, And with our in-house programs, I'll just come down here. You'll find our in-house programs are fully explored and talked about in this workflow processes, trend following and momentum models. Within this section of the forum, we've got both our SQX processes as well as our in-house processes. So if they click on this one here, which is a portfolio development and compilation process, they will see, and they go to the first post, they will see in the very first post, they will see a step-by-step overview of this entire in-house process. And this is basically the workbook or the guide to use to step you through this process. Louis, this is the one you used?
Yeah, exactly. I just followed it literally step by step.
Step by step. It's very detailed. There's a lot in there, but so that's where our members can obtain this information.
And just to clarify, Rich, I was completely new to trend following, so when I was first reading it, I didn't really have a clue. But as I got into it, and the more I tested it, the more it all started to come together. So you can follow it even as a complete newbie.
Right. Okay, so is there any guidance you'd give us here, Louis, as to make it easier for our members? Like Fred and I sort of assume it's fairly straightforward, but it might not be.
I think it's like anything, Rich. You just need to get into it and just follow the process. I mean, some of it isn't sort of clear. I think it's just for me because I wasn't really into trend following. So maybe someone that has a bit more of a background would understand it and pick it up quicker. But yeah, I think you just need to go through it one by one, and even if you're not entirely clear, just follow the process, and you will get there.
Okay.
Maybe, Rich, what we should do is have a section 0, which introduces the concept of what is trend following and why are we doing it.
I think that can be found, Fred. You've just got to probably get more into the blogs, and maybe you just have to read up and look at other information before you actually start the overall process. But yeah, you're right. Maybe that would be of benefit.
Or even just a summary of the blogs to read, possibly.
Yeah, potentially.
That's a good idea. But look, as you step through it, the first step, we talk about an overview. And if you click on this overview here, and we go to the first post, I'll just scroll up to it. Here we just introduce the concept, give you a brief overview of what the intent is of this entire workflow process. And so that basically gives an introductory overview of the workflow process. And I'll just come back here. Then we get into the different components of the workflow and introducing the workflow. What is a workflow? Which is a method of data mining effectively that is a procedural automated process that starts out broad and slowly narrows down until we've developed particular algorithms that then we ultimately compile into portfolios. But then we get into the first step, and the first step of the entire process that we take with this in-house process is this design phase. And I'll just come into that now. So with our particular method of data mining, we adopt this design-led process. So when you find these data mining software programs available on the market, a lot of them you can either automatically develop strategies just by putting in key performance metrics. You might want a strategy that can produce a particular compound annual growth rate, or have a minimum drawdown, or have a certain number of trades. You put those criteria in, and then the data mining process actually then generates algorithms that meet those performance criteria. Now, those particular algorithms that generated could be any form of algorithm. They could adopt any form of style or any form of arbitrage opportunity, but the ultimate result is that they prove from the backtest environment that they can generate those performance metrics. Now, the problem with those style of algorithm development modules is that they often develop curve fit solutions that have no rhyme or reason. There's no causal backing to them. They've just managed to develop solutions that match the past historic data. There is no sort of causality embedded in those algorithms. It's just how the data is played out. So what we adopt is a design-led principle where we first identify what is the type of trading system we want to develop and what is the arbitrage we're trying to seek here. And in this particular world, we're seeking trend-following trading solutions, which are targeting the fat tails of the market distribution of returns. So by having an understanding of the edge we're trying to target, that therefore significantly restricts how we therefore data mine for that particular solution. So with our design-led principle, there are certain key golden rules we apply to our design principles that must be found in every single solution that we develop from this workflow process. And the key golden rules for trend following are that we need to cut losses short, let profits run. We must always focus on risk management and preserve capital at all costs. That therefore enforces things such as stop loss and trailing stop losses into our solutions. We've got to keep our models as simple as possible so they avoid any form of predetermined curve fit design. We want our models to respond to a variety of different trending environments, and therefore the more simple a model, the better chance it has of navigating a broad array of different trending environments. And we don't try and pick the bottoms or the tops of the trends, we attack the meat of the trends. So those core design principles are built into the models that then we data mine around. So Fred, I might flick over to you now, just explaining these core design models.
Yeah, go back a little bit first to the general software that's available for data mining, and what you said was you dial in your requirements and out pops the solution. The reality is that solution is really, it's navigated its way through previous price history and came up with a particular scenario that says, well, had that history been, if we could repeat that history, then in theory we could make profit off that EA. What we're doing here though is we've turned that around and say, well, actually we want to try and keep it really simple, keep it focused, and see how that performs over time. And if that can hold through and be used throughout, then that gives us a much better understanding of what we're doing, but also better repeatability, and we're not so limited to following exactly what happened in the past, but looking at more generically what we're looking at. So with our principles, I mean, there's a couple specific ones, but taking a breakout trader initially, and what we're looking for is a higher high price or a lower low price, and we're using the Donchian channel to give us that definition. So what we're looking for here is if we see a repeatable pattern that says, well, we've had a 52-week high, and if we were to enter on that particular trade, then with a particular stop loss setting, we could in fact potentially realize some profit. So that's a fairly simple approach. If we get a higher high, we take a trade, as opposed to some random solution that may or may not occur again. So we've got four particular strategies. One is a Donchian break, where we have effectively the ability to change the look back period on the Donchian. We also then have various trailing stop options that goes with that Donchian channel. And the idea there of the trailing stop is if you have a tight trailing stop, potentially any whipsaws are going to be knocking you out. If we're looking for a really long-term trend, then potentially we need a wider stop loss. So by data mining for different combinations of look back and trailing stop scenarios, we can get a particular set of scenarios that hopefully will be robust enough to travel into the future. We also have the ability there to set a break-even setting at some point. For example, we might wait for price to travel 2 or 3 ATR away from entry, and then we'll move to stop to break even to avoid any potential loss on a pullback. So all of those variations come out of the Donchian, and we've called that the Don model. We've got a similar model which we've called the Bow, which is pretty much based on the same concept, but for those who want to see some profit, we've actually set a profit target. So we're not realizing the longer term trends in this scenario. We're looking for potentially a 2 ATR, 3 ATR, 4 ATR, 10 ATR profit target to take us out of that trade. So with the combination of the Don and the Bow, we've got potential for hanging into long-term trends and realizing some short-term results from profits as they reach profit target. So those two work in concert with each other, and through the data mining, which Rich will talk about shortly, we can get different combinations. So to offset and provide an alternative entry method, we've used the moving average crossover. Typically, you'll read a lot about the moving average cross, and you'll find a lot of data that suggests that doesn't work. Well, in our data mining here, you'll see that it can be made to work. It's just a question of finding the right combination of moving average and, again, trailing stop and move to break even. We've also got the MATP, which is the complement to that, where we do set a profit target. So those are the 4 strategies we've started with. We're considering adding to those scenarios, and we're looking for people to give us ideas there to see what they want to try. But one of the next ones we're looking at is an entry off a pullback, for example, and we may consider using a Bollinger Band. If we get a break of a lower band, we might see that as a potential reversal point. The idea there is to try and get in at the beginning of a trend, whereas the Don and the Bow typically pick up when you already got a trend established. A pullback reversal could give us an earlier entry, and so we're going to explore that as an option. But there are other multiple ideas that have been kicked around. We might have a consolidation period followed by a breakout. There's a whole bunch of different things we're playing with, but for the moment and for the strategy here, we've got these 4 to choose from. And as you can see from Louis' portfolio, he's managed to combine these to deliver a pretty healthy looking equity curve.
Louis, did you use all 4, or did you just use the Don and Matt SL?
I used all 4, Rich. So I just followed the process, and just whatever it sort of spat out, I ran with. So it's just a mix of all 4 across the board.
Okay.
But what I did do is just limit the number of strategies to 4. So I think on the forum we had a range of 2 to 7, but I suppose it just depends on the risk matrix and how you want to run with it. But yeah, I just selected 4 in the end.
Gotcha, mate. Because one of the portfolios that Fred and I developed, we just focused on the Don and Matt SL, simply because the Bow and the Matt P were both using profit targets, and we thought that was a sort of compromise in our world of trend following. And we thought that we'd give a shot just using the methods that were trend following in nature, gave us a degree of diversification of entry, and had a trailing stop loss as opposed to a take profit target.
Right.
But that seemed to produce a pretty good result as well. And if we develop these further models as well, we might actually not need to rely so much on what we're referring to these 2 models here as supplementary models. The Don and the Matt SL as our primary trend following models. So hopefully we don't have to rely on these as much.
It is. Sorry, I was going to say it is conceivable to generate a whole portfolio just around one of these. You don't need all 4.
Right.
It's just a combination of whatever you feel you want to try. You might find that like 5 EAs based on the DON across 20 markets might give you a really good equity curve. It's a matter of analysing the data and figuring it out.
Yeah, it might be worth exploring and doing a little bit more testing around 2 or 1 or 3. Yeah, it's something I'll definitely consider. I think the plan is just to get the portfolio up and running at the moment, and I'll probably test a lot just alongside.
Yep, definitely.
Sorry, Lou, I cut you off there. Were you going to ask a question?
No, I've just said it there. I think. Would you just while I'm on? Would you I was just thinking in terms of how much I'm risking across the entire portfolio. Would you go for diversification across assets, or would you prefer to go for diversification across system design? Is there a balance or one you should go for, or?
Look, you probably get diversification across assets. Probably gives you you won't get as many occurring at the same time necessarily, I don't think.
Right.
I don't know, Fred. What do you think?
Well, the reality is, if you're chasing, just say for the moment we're using just a Donchian break, chances are that when you get a Donchian break of say 1,000 bar look back, that same signal will come up as an 800, as a 600, as a 500, as a 50. So you might find that a Donchian break model, if you've got 4 EAs or 5 EAs, they might all fire off on the same bar. And so while you've got different trailing conditions, you are not particularly diversified because you've got 5 triggers off the same signal. Whereas if you go across markets and limit the number per EA, you'll get a greater spread. And I think if you do some reading, you'll find that the broader your portfolio, the less risk you take. So in that sense, my vote would be as many markets as you can find, and probably as many models as you can find. If, in theory, you could probably max out about 200 EAs, and you might find your drawdown characteristic gets nicely smoothed out. Got
you. Understood.
I quite like what you've done though, Louis, having 4 models. Yeah, with the 4 models or 4 algos per market. It's not a bad grouping.
Yeah, exactly. That's what I was thinking, just to kind of limit the exposure. But I suppose it doesn't really matter how much risk you're taking across the portfolio because of the co-integration, and you've got them sort of you're hedging, or you will be hedging. So I suppose it doesn't really matter.
If for instance you were just trading in equities, yes, there'd be a big concern there. But because we've got the broad cross-asset diversification here the good thing about Forex is they're very symmetrical in strategy. So, the Euro USD is not just a product of the Euro, it's a combination of, the Euro or the USD moving, and the relationship with the pair nature of the Forex really makes it good for trend following models for correlation benefits. But if you're trading some of the commodities, some of them do have a long bias to them. Indices certainly do have a long bias to them. Too much exposure in indices, I think, could be damaging.
Yeah.
Especially when it all goes pear-shaped. But, because we do cut losses short at all times, there will be a time where we can get multiple trades all closing off together, but the material nature of the loss is small. So, but we might get, a 3% hit or a 4% hit, but it's unlikely to get a 10 or 15% hit, with the way we've sort of compiled our portfolios. But we do keep an eye on our portfolio heat at all times, but the chances of heat actually eventuating is almost impossible from what Fred and I have looked at.
Right. Interesting.
So we've talked about the design first principle and the design models we have for trend following. Then also we need to define our universe. It's pretty straightforward. We've already discussed this in this episode, where we're looking for broad cross-asset diversification across asset classes. So we want exposure in commodities, whether they're soft commodities, whether they're metals. We want a degree of exposure in indices. We want a good exposure within the Forex asset classes. So the idea here is that the way we approach this is that we actually don't really make an assessment of what universe we're going to target to start with. The prime aim of this process is we choose as many instruments that are liquid in nature, have a long data history, and basically can be funneled through this workflow process, because it's at the end of the exercise we can make a decision to reduce our portfolio to a defined universe. So really, you don't really need to make the decision about what universe you're going to trade to start with. What we'd be suggesting is trade as many of your markets as you can within this, or put them through the workflow process, provided they are liquid. Across asset classes is always good. If they offer micro lot or mini lot availability, which is important for us retail traders who've got limited capital, and the data history availability, the longer data, the better. Once you funnel all of those instruments through, then at the very end of the portfolio compilation process, when you're compiling it within Quant Analyzer, Louis, you would have found this as well, you make decisions there regarding which of your returns or which of your markets you want to exclude by virtue of their negative skew, how they impact on the overall portfolio. And by that process of compilation at the end, you start actually then defining the universe you'll be trading with. Would you agree with that, Louis?
Yeah, exactly. It was, I think, again, the spreadsheet's great. You just plug in the figures, follow the process, and then you can see, I think it even highlights ones in red that have negative skew. You can look at the correlation. You can look at the map to market. So yeah, it's great. And I done that on the spreadsheet before I transferred it across to Quant Analyzer.
Gotcha. Great.
Just a word on data history, Rich.
Yep.
We talked about this offline yesterday, didn't we? Where we said, well, we can't get a lot of data history on Bitcoin, so how could we include Bitcoin in our portfolio? Do you want to talk through that a little bit?
Or you made a look. I can certainly talk. What we'd do in that instance is, with the workflow process, we data mine initially using a particular market such as Euro USD, but then we ensure that it has multi-market capability. When we can determine with confidence that a particular solution does have multi-market capability, that means that potentially it is something we could trade with Bitcoin, even though we don't have much data available for Bitcoin, because we know that these solutions are robust across a broad array of different market environments and different market data. So theoretically, if over a short data history of Bitcoin, say of 10 years, if an algorithm that has already passed the multi-market phase of, say, 30 years on multi-market for other markets also works within the Bitcoin context, we're confident we could use that as a Bitcoin algorithm.
Got you. And does that apply? Sorry, Rich? Does that apply to other markets as well? Like, could you apply that to individual stocks? Like, if the broker offered that, or?
Look, I would definitely, I wouldn't be trading individual stocks.
Right.
I would be indices, yes. Look, Jerry Parker had a very interesting thing to say in relation. He's regretted. Jerry Parker runs the Chesapeake Capital, which is a well-known diversified systematic trend following fund. And for the last 5 years, he's been heavily involved in trying to develop systematic trading, trend trading strategies within the equities environment, trading individual stocks. Now, he's come out recently saying he's regretted that move because the degree of correlation within the equity market is significant, and all of the benefits you might get from diversification are lost when you're trading these individual equities. But Louis, I'd definitely be doing this process for Bitcoin. I'd definitely be doing it for any other asset class that you don't have significant data for, but in relation to specific individual stocks, I wouldn't be using this technique for that.
Yeah, it was just a thought, just to throw it out there, really. I mean, I didn't really have any intention. I was just thinking for wider diversification. I know it's been mentioned in the past. I was just wondering, really.
Fred, you might have a few views here. What do you think?
Individual stocks are a bit tricky because they're not particularly. The correlation, when something goes sour in the market, they're all going to go sour. So you're not getting the benefit of different markets effectively. But coming back to Bitcoin for the moment, you probably wouldn't use the algos out of wheat, for example, to try on Bitcoin. I'd be more tempted to use the currencies as opposed to the indexes or the commodities, only because Bitcoin's probably going to trade a bit more like a currency than anything else. And so, you could try it and see what you get, but a lot of our commodities, Rich, if I'm not wrong, end up being long only type approach.
Yes.
Which is not going to necessarily suit Bitcoin. So
look, we do have both short and long. We do find some commodities definitely do have a long bias, and inevitably that does flavour the algorithms that are developed through this in-house process. So look, we'll get into that where we look and assess them for their symmetrical nature, or whether they've got a long bias or short bias in the in-house process, and that. I've found that in a lot of our commodities, we've found that some of them are only long only. Have you found that, Louis?
Yeah, definitely. Like the soybeans and sugar and coffee and whatnot does seem to favour long only.
I'm thinking back to when we got that big spike in silver a few years ago. That kind of looks like the same pattern we're getting on Bitcoin. So whether silver would trade well on Bitcoin or the silver EAs on Bitcoin, I don't know, but it's worth exploring. I think if you're trying to work everything on data from 1985, well, some of these things don't exist in 1985. So from that point of view, they inherently don't make the grade. Whereas using this approach, using EAs that have been proven already, in multi-market scenarios, if they show up a good recency in Bitcoin, then go for it.
Yep. So now that all of that has been done, we've looked at the design phase, we've looked at the universe. Now what we can do is actually get into the algorithms themselves, and in the first phase of the workflow process, we are focusing on the robustness phase of the process. In the latter phases of the process, we then look at the recency phase of the process. So to start with the robustness phase, what we do is we apply our first algorithm to our universe that we've selected for the purposes of testing. Rather than call it a universe, it's more like the individual instruments that we'll be testing.
Rich,
yep.
Just thinking, we've been going for nearly an hour. I don't know what Louis' time scale is like, but is this a good time to maybe pause for another day, or do you want to keep going, or how do you want to go?
Guys, well, Friday then.
No problem.
Okay.
I appreciate it. Thanks very much. Cheers. See you then, Fred. See you later. Bye-bye. Bye.